Good morning, ladies and gentlemen. Well, this week was a complete waste of space. The spreads started and finished at -9. If we have a look at basically it just stayed constant throughout the week, and the one average minus the other actually improved to -42. As you can see, we have the score going up, and so the averages are coming in. But this is nothing that didn't happen in 2008. So we are either going to have at some stage a break up or a break back down. So we are either going to return to 2500 or basically have room for a sustained move higher in the risk parameters. If we look at the deviations, this is what is interesting to me, is that we are starting to have the red line rising, and basically in the next week or so it'll be at 28.61. It is now at 28.36. In the next week or so it's bound to get to 28.61, and that is the breakdown point from which we had all the price action from October of last year till early December, and that is the scene of the crime. The markets nearly always return to the scene of the crime. 28.61 is the level that we have to have in mind, which is even more important than these levels here around 28.10, 28.20. 28.61 is going to be extremely important, and I will show you why. Well, is there a canary in the coal mine to tell us which way things are going to go? To me, it is very interesting that we are at the same level today in 5-year notes in terms of yields as we were the day of the brutal move down into Christmas. It is amazing to me that throughout this rally in the S&Ps, which is now nearly 15%, we have not moved one iota in terms of 5-year yields. 10-year yields are very slightly different, and 30-year yields are very slightly different too. That to me tells me that this whole rally is actually predicated on lower rates. And this is basically what the Fed has engineered, lower rates. Now, if the next move is back down, which looks increasingly likely to me, that is actually our canary in the coal mine, that fixed income is still a better investment than equities. On a chart of the Bund, you can actually see that we are lower in yield than we were at Christmas time. To me, that is incredible. If this economy, if the world economy is doing so well, what are yields doing down here? The only way they can keep equity markets higher is by having ever decreasing yields at the long end. We are very close, and we could easily break through this 7 basis points, which would take us to -14, -20 in terms of the Bund yields. That is extremely significant, because if they can only keep equities up by having ever decreasing yields, that is a finite tool. It cannot really be used forever. Either the economies can stand on their own 2 feet without ever decreasing yields, or they can't. No change in the spread between the Bunds and the 10-year notes, still stuck in this amazing tight range, -258, -247, 11 basis points. 11 basis points of divergence between the yields in Europe and the yields in the United States for such a long time is quite incredible to me. No trend whatsoever. And this is the way they're actually manipulating the market, the central banks, by having these incredibly tight ranges. I have been bearish on the VIX for quite some time now, and it's finally got to 13.5. On the weeklies, we could easily get down to 1150, 1170 in the next couple of weeks. And that to me says the market is likely to break this 28.12 level and go to 28.61. This is the level where you can really start arguing with what is going on, because all the factors from volatility to bond yields to everything else will have reached a level where you can have some amazingly good risk reward plays. This 1170 level, if seen next week, is going to be a fantastic buy. Another canary in the coal mine is actually the spread between emerging markets and the SPY. If you have a look at where we are from 2016 onwards, we have gone absolutely nowhere from the beginning of 2016. So that's the whole of 2016, 2017, 2018, and now in 2019. That is almost 4 years of trading, well, 3 and a bit. And we have gone absolutely nowhere. We've gone up a bit, down a bit, and completely unchanged in terms of yield, in terms of spread difference. That means that had you invested in emerging markets in 2016, you would now have the same return as you would have had you invested in SPY. The difference being that emerging markets have a yield of 2.8 against SPY, which has a yield of 1.8. So you would have made an extra % a year in terms of yield, which compounded would give you approximately about 4 to 4.5% more now had you invested in emerging markets. And that is despite the amazingly brutal bear market we had in emerging markets in the past year. This is a daily chart of FXI, which is China, one of the main components of the emerging markets. You can see this huge rally that we've had since December 2019, and that actually is what has been dragging up equity markets. We have this very important level here at 44.80. You can see how when we are above 44.80, good things happen. When we are below 44.80, very bad things happen. To me, that is going to be the crux, and I would have thought that we'll be at that level exactly when the S&Ps are somewhere between 28.12 and 28.61. So that is going to be a very, very important swing level to keep in mind. In the S&Ps, we've now had 9 straight weeks of gains. The top of the Bollinger Bands next week, at a guess, will come somewhere around 28.61. It's amazing how these levels are reached in at certain times. First of all, we have the 28.12 level that we have to get to, and that will happen very early next week, I would have thought. And after that, the level is going to be the level that we held for such a long time, which is going to be 28.61. 28.12 and 28.61 are the levels, and you know the difference between 28.12 and 28.61 is only 1.5%. So that is the area where you want to really start arguing with this market. What is important to understand, and how I will construct my trades, is that the 26.77 level is the level that we broke above when we had the speech from Powell, and that is the level that we will find very difficult to break through, and we can see that on a daily chart. And here we can see this level. This is the very important level, 2677. To me, this is absolutely the most important level. While we're above it, we are still bullish. When below it, we will be bearish. But I don't think that this level is going to be broken anytime soon. It is where the market, when finally it strikes the overbought level, whether that is 2813 or 2861, it'll come back down to. This will be the level that the central banks will defend at all costs. So what we are saying is that the market up here, you can buy ratio put spreads to your heart's content, having 2-3 month puts with cheap volatility against times 3, times 4, times 5 short puts at that level on a much shorter basis, and I will tweet that trade to you next week. NQ is even more interesting. I've had these levels 71.81 to 72.86 marked for some time. I would not be surprised to see next week a strong move up to 72.50ish. That will be my signal that everything has converged, and to get ready to buy some puts in NQ as well. The situation in Europe is very much the same. Next week we should reach the 3300 level. We're only 1% away, and that is where we can certainly be looking for the market to turn and have a significant pullback. Back certainly down, I would have thought, through this kind of level around the 3100 level. That is that's a 7% move or something like that. So Europe is looking far more bearish to me still than the States, or especially emerging markets. To me, anything that gives you a greater yield than the S&Ps at a much lower book value and a much lower level of forward earnings is a much better buy and a much safer buy. Just to show you where the blue angels are, we are now well past the time 16. We're going up towards the time 17 blue angel. This is completely unsustainable in the long term. This will not last. There isn't a single period in history where this has lasted. We are building something which is unsustainable here. At some stage there will be a significant pullback back down to that 2677 level that I indicated. So it's just a question of waiting, timing it correctly, getting in as close to 2861 as possible with low volatility, and having ratio calendar spreads with the downside stuck at that 2677 level that I indicated. The dollar is just not speaking at the moment at all. It is just hugging 96.50, which is this very important level. It's as if it had a magnet, and it's as if people had decided that we've got to hold 96.50 and not let it go much higher than that. At some stage they will have to. This is becoming such an area of compression. The move from it is going to be almost epic. It's a question of being patient. It's a question of just waiting for it. And we have our levels. They're still the same. When those levels break, the move will be absolutely very, very large. Another spread indicator which is telling me not to chase to the upside because other people will now start chasing the equity market is the spread between the XLF and the yield curve. The yield curve is now, as you can see, returning to the lowest levels of, absolutely zero, basically, in terms of the spread between overnight money and 5-year lending levels. Very soon this is going to exhaust when we get to around 22 or so in XLF, and from there the move back down is going to be pretty hard, and certainly that reinforces my belief that we will see 2677 at some stage again, and that we are definitely in a much better position to do the ratio put spreads from the 28.12 to 28.61 level all the way back down to 26.77. Well, nothing much has changed in terms of the biases in the bonds. Still the range is 240 to 260. That is awaiting the hard economic data. If it confirms the very bad retail sales that we had for December, God help us, because yields are going to zero. Here I've put in those levels: 28.12, 28.61. They're still there, and 26.77 is the downside level that will hold, absolutely will hold. They will do everything they can to make it hold. VIX, now we reached the 1325 level, just about. 1175 is the amazing level that, if we can get in there, we will gonna have such a fantastic return. It's not true. Risk reward 1175 is a fantastic level to get into. 1325 reached. I'm not surprised by it. I will be surprised if we exceed 1175 on the downside. That would just be amazing. Here we are, 3275. I just showed you the level around 3300. If we see 3300, I will be doing the ratio put spreads just the same as in the SPX. And nothing new about the dollar. 95.07 is the next level down, and 93.63 is the level at which we go berserk, as it were, because that will see a fantastic move either way. Thank you very much indeed, and tweet to you on Monday.